a lot of things can happen between then and 29 and a half years old. So as far as you're concerned, those two securities have the same risk profile. Yeah, if you're thinking about default, you know, if US is going to default in 29 in 30 years, they're probably going to default in 29 and a half years as well. If inflation is going to be high in 30 years, it's probably going to be pretty high in 29 and a half years as well. There is no way for anybody who's not touched by divinity to actually predict the difference. So there's no rational reason why the yields should be that different, but they are. And the new bonds have a lower yield than the old bonds. And that differential varies sometimes, but uh, it may be as high as 10 basis points. Now, if I have enough financing, I can do the following. I can buy the old bonds. Let's say the new bonds are yielding 4%, the old bonds are yielding for 10%. Remember, prices are in inverse relationship with the yields. So the old bonds are cheaper. I'm going to buy the old bonds and I'm going to repo them. Repo means you basically do a collateralized loan. And that's very common. You can even do it with the Fed. You tell Fed, here's these $100 million worth of 29.5-year-old bonds. Keep that for one night, okay? And I'm going to buy it back from you next day at a certain interest. So that's uh, how you finance that. Or you can actually do, you can buy the 29.5-year-olds, repo them. You could short the 30-year bonds, and you could do reverse repo. If this was a fixed income class, I would have gone through the details of it. Uh, this tells me I should do a fixed income class, but I keep telling people, nobody says go ahead and do it. Uh, so you can consistently earn that 10 points differentials. But if you do that as a multiplier 100 times, then that 0.10% suddenly becomes 10%, right? And you're basically making 10% plus the yield on the base old bond, 14%. In any bond fund, if you're making 14%, you're the king, all right? And long-term capital management did this a lot. And these guys say our benchmark is 30-year treasury bond. So if your fund makes more than 4%, then you actually charge your clients a success fee. A lot of hedge funds work with base management fee. It varies from fund to fund, but that's typically about 2% of assets under management. And then a success fee that's typically 20% of abnormal return. And abnormal return is actual minus the benchmark return. Suppose I'm managing $100 billion. I'm long-term capital management. I'm going to get 2% from management fee a year. And in this made-up example, my outperformance is also 10%, right? I'm going to get 20% of that. So that's another 2%. So I'm making 4% of 100 billion. Suddenly I made $4 billion. All right. And you're probably thinking there's no reason why these guys shouldn't keep doing it. And in 1998, we found out what was the reason for that yield differential. Uh, Summer of 98. Anybody knows what happened significant that summer? Uh, Summer of 98, Russia defaulted on all of their foreign payments. Okay. Boris Yeltsin was president, and this Putin guy was only his second. At that point, he was, I think, the prime minister or something like that. And was about 6 years after Soviet Union had collapsed, and a lot of Russia's revenues were based on oil and gold and silver. Okay, selling those natural resources. And oil went down as low as $10 a barrel. This is 1998. In today's dollars, that's probably equivalent to $5. Currently, one barrel of oil is worth what, $70 now? So it's pretty low. And Russia could not keep up with their international obligations because they had a lot of bonds they had issued in dollar terms. And they basically said, they didn't say we're going to default. Uh, we are declaring a moratorium on foreign currency payments. If you want your euro bonds, which are bonds denominated in dollars, even though they're called euro bonds, to be paid, we'll pay the ruble equivalent of that to you. But they use the rates that were before they announced what you want to call moratorium. At that time, $1 would buy you 6.5 rubles or so. The day after they announced it, that exchange rate went up to 30. That means ruble lost about 80% of its value. It was effectively default. Guess what happened? Long-term capital management suddenly became illiquid. Here's the reason. For good or for bad, there is a phenomenon in markets called flight to quality and flight to liquidity. Whenever something really risky happens in the markets, uh, when sudden fear happens, assets that are deemed safe uh, get a lot of demand. And typically these are US dollar bonds, Swiss francs, okay, and gold. I don't know why they consider that a safe asset, but it's what the market does. It is not up to us to question why they are doing it. All you need to know is that they are doing it. Now, when that happens, the difference between old and new bonds is liquidity. New bonds are a lot more liquid than old bonds. And when Russia defaulted, this obviously created risk for a lot of economies, especially Germany. You know, uh, this was before euro. That day, German mark, the Deutschmark, lost about more than 5% of its value against dollar. in currency markets, that is huge. Okay, value of Colombian peso may lose 5% in a day. Nobody would bat their eye twice. That's normal in that type of currency. But when you have a currency like Deutschmark, in fact, arguably it was considered stronger than dollar those days, but they had so much exposure towards Russia, especially some of their biggest banks, Deutsche Bank, for example, they were exposed quite a bit. A lot of short-term assets went from Deutschmark to US dollar. When you're investing in US dollar assets, obviously it's a risky environment. You're not going to put it into stocks. You're going to buy bonds. When you're going to buy bonds, which bonds are you going to buy? The ones that are more liquid. Suddenly, there was a lot more demand for the new bonds. When something has a lot more demand, the price of that is going to go up. That means the price of old bond is going to go down. So these guys shorted the new bond, which means they're losing money on that. And they're long. Long means you benefit if the price goes up. They're long the old bond, and the price of that is going down, relatively speaking. So that differential was turned actually negative. The new bonds now had higher yield than the old bonds. But if you had done this only leverage once, it wouldn't create that much issue. But these guys were 1 to 100 leveraged. Here's was a strategy historically made a lot of money. So if you look at only historical evidence, you're thinking the markets may not be efficient because this thing over the last 50 years made a lot of money. And if you have access to a lot of funding, you can make a killing out of that. In fact, that's what long-term capital management did. But suddenly, they were insolvent. They could not finance those positions anymore because most of it was overnight financing through the repo markets. And it was so bad, Fed had to intervene because who was financing these people? Companies like Goldman Sachs, J.P. Morgan, I don't know, Bear Stearns, Merrill Lynch, what have you. It would have created a chain effect. If Fed allowed long-term capital management to be bankrupt, more than likely, at least, Bear Stearns and Merrill Lynch would have gone bankrupt even before 2008. So Fed came in and took over long-term capital management, and they said, okay, we're going to fund these for now, and you don't have to worry about what you're going to get. Suddenly, you realize that there was a reason for that for those returns. Okay? So the evidence, just because you saw that there was evidence of abnormal returns, so you couldn't say bond markets are not efficient.